Hello, everybody. Thank you for joining us. We're off to the races here. We're going to go ahead and start our fireside chat with Mike. Just bear with me. Excellent. So hoping our AV is working well. Welcome to our MainLine West annual update. Certainly appreciative of you all being here. And I'm going to go ahead and start with our first few slides, give you kind of a brief outline of our topics. Mike is then going to cover the bulk of the material. But again, thank you for joining us. I'm going to grab that. Excellent. So MainLine West 2025 outlook. I thought this was a really good tagline here that Mike came up with. 2024 market review, off the roller coaster and onto the Ferris wheel. Obviously, 2022, 2023, kind of a multi-generational historic rise in interest rates. So that was certainly a unique, experience out of the last really 15 to 20 years. Mike is really going to cover the 2025 outlook because I think we've got some really interesting policy and fiscal questions. We're going to talk about MainLine West in 2025 and then review the funds in specificity. Really the highlights for MainLine West. We continue to grow our AUM methodically. We're at $1.7 billion, so that's our 17th year of asset growth. We now have 4 opportunity funds as well as 2 private client funds that are operational. Really want to again highlight our focus on value-added strategies, low cost, customized SMAs. Really, this third bullet point is kind of interesting. We feel like munis are to a degree, ground zero for the climate change impacts on muni issuers. We've done a ton of research and work on that we'll be sharing with you. And most importantly, we remain committed to the best price and best execution, really getting, client capital working as efficiently as it can for that capital base. We also want to highlight, we've, expanded our personnel. Craig DeRizzo is here. He's going to really, start to develop our, SMA and RIA business. Mike, I'm going to hand it over to you and go for it.
All right. Thank you, Brad. Thank you for joining us here today. It's getting a little late on the East Coast and it's freezing in Denver. So it's a lot of, appreciate you guys joining us give us a chance to kind of talk about what we saw happen in 24 and what we believe is going to happen in 25. What is the red dawn rising, white swans setting? For those of you who did not read the outlook or still are puzzled with it, this is a reference to the Republicans are controlling the government, the House, Senate, and the president. And with that control they have brings about a set of risks to the muni market that we need to focus on in the years to come. It's not been a historical case where the Republicans are anti-munis. It's just that in recent times, they've had some legislation and some thought processes that have been anti-muni. And we feel like that's going to come back up here in 2025 and is going to be something that the market's going to need to deal with as we move forward. 2024, well, we had a presentation here towards the end of 2023 where we highlighted the roller coaster we had been on. We had movements of rates of over 2 standard deviations, which is over 200 basis points, several times in that time frame. We had record Fed tightening. We had an inversion of the yield curve, and all that added volatility to the muni market and to all the markets. And that provided a lot of challenges for our funds and our clients. Well, happy to say 2024 volatility was not a highlight. Volatility was quiet. I have a chart down here to the right showing just along the 15% or low until we got to the election. And then the election things started perking up, and things are still perking up right now as we move into 2025. The highlights of 24 though was first of all record issuance, and this is just not going to be a one-year phenom. We broke over 500 billion in new issue bonds last year. We've continued our platforms and how bonds are trading is an evolution to electronic trading, which is leading to SMA growth, separately managed accounts. They're harvesting assets at the expense of the mutual funds. And by the end of the year, munis had a kind of a quiet year, clipped the coupon, which offset higher end of year rates. So on a performance basis, munis, this is not adjusting for taxes, was up a little better than treasuries, but was not quite as strong as corporates. Now there's talk about before, it was pretty quiet for munis. We traded within a band of 50 basis points most of the year. And it was not, it was a little up, a little down, a little up, a little down. The nice part of this is as we get to the end of the year, you can see munis were at pretty much their highest point of the year in rates, which gives us a good starting spot going into 2025. So the highlight in 24, I think the biggest theme was the new issue calendar, breaking 500 billion at 506. This, as I said, is going to be a theme going forward. Why is new issue going up so strong? Well, first of all, infrastructure needs have been big and have been growing, and the process of the states and everybody taking care of that was kind of delayed for a number of years. There was some red tape, and costs to borrowing costs were a bit higher. That has worked itself through a little bit. Now those projects are starting to come to the market. There's projects now just coming to market to prepare for and adjust to climate change, where a county or a state is revamping something that they own that can hold up better in a case of a hurricane or in a case of flooding. So we are seeing deals coming just specifically to help shore up anticipation of problems due to their concerns with climate change. Tax revenues are lower, they're slowing down a little bit. The increased cost of projects due to inflation, everything they're building today is a lot more than it was 3 or 4 years ago. And to add that to the end of it all, into federal aid and stimulus, they're not getting any more handouts from the government. So now you have the case of big needs for new projects, less money coming in, higher costs for your projects. So that all adds up to guess what? More debt. More debt for each of the municipalities issuing. More debt means more new issue calendar for the muni market. 2025, we've dawn of the red wave. We have not just that DC to worry about in 2025. We have numerous other challenges we feel that the muni market is going to have to work its way through. Looking back historically, I mean, munis always find a way to have a bad year, or find a way to have something get in its way. I mean, I remember 2019 going to 2020, we had big concerns with where munis were relative value. Didn't know COVID was going to hit, but we had concerns at that moment in time. Going back to 2010 with Meredith Whitney, she took us into the next year. We had concerns with what was going on in that case. This year, we had those same kind of concerns. We have concerns. Munis are not properly evaluating the risks that we feel are coming on the horizon. And that is what has set off in our concerns with this, we call the red wave. Those are the risks that the muni market, I think, has really put to value yet. We have credit outlook that we feel is going to be an issue going forward. Why is credit going to be more of an issue? Well, because they're issuing more debt and revenue is slowing. So that's going to weigh in. We're not saying that muni is going to default a lot more, but you're going to see a lot more credit downgrades. And you're going to see that it's going to cause pricing to be, the bond's going to come cheaper or wider, and the bond that you own is going to trade off a little bit because of that. And then, of course, we'll go through more specifically our red wave risks that we're concerned with. But there is one good note as we go into 2025, and that is the tax equivalent value of munis. Munis have finished the year off at a fairly good spot. Where we are today is close to the same level, maybe a little lower on the 10-year and a little higher on the 30-year in yields. But the tax equivalent yield right now represents as good a value as it has since 2014. And going into this year, you're hearing a lot more people talking about fixed income and the value of fixed income. You add that to the demographics of the aging populations, you get wealth advisors now talking more and putting people more into communities. Our small world, we sit in here, our 1.7, we've seen a wave of new advisors and clients wanting to put more money to work going into this year than we have in the past. What are the red wave risks? Well, I got 3 of them specified here. A couple of them are more concerning than others. These are the things that will hurt, upset, cause distortions in muni values as they come up and discuss. So first one is this tax rate reduction. Republicans are looking to extend the current tax, 2017 tax revision. So they want to hold at 37%. That's not a big deal in muni land. That's where we're priced at. That's where we are. There's thoughts that maybe they might try to go further at some point in time. I'm not sure if that's going to be the case or not. They're talking about corporate tax cuts, tax rate cut. If that happens, munis might feel it a little bit, just a brush in the breeze, but not a lot. That risk is a risk that's out there. It's not one that we here are that concerned about. It's the 3rd lowest on this. The second one, though, is the biggest one, I think. The restriction of tax exempt status for select issuers. Back in 2017, when the tax code was revised, there was a provision in there that was going to keep hospitals, higher eds, and airports from issuing tax exempt debt. They were perceived as not-for-profit. And when that provision was in the document to start 2017, those issuers sold as many bonds as they could, concerning that they may never be able to sell tax exempt debt again. That was the 1 month. That 2016 December was the highest 1 month issuance on record. I think it was 68 billion. So the concern here is whether that happens or doesn't happen, the threat of that can impact our market. It can cause a huge wave of bonds to be sold that maybe the market can't absorb at that moment in time. And I don't know if you've already heard any of the stuff going on from DC, but you know you've heard the fact that they're not very fond of the higher academia. So the Harvards and the Stanfords have already been put in the crosseyes in DC. So this to me could be one of the highest risk components from the red wave. The third, the potential loss of tax exempt status. I laugh when I see that, because to me, my whole life, the benefit of tax exempt issuance to me is solid and should never be questioned. But there has already been put together a menu for reconciliation, all the projects and things that they could do to save money to extend their tax benefit. And in that document, in that menu, this is in there. So it's in there. It's going to be discussed. How long gets discussed, I don't know. But the other reason I spend more time on this now than I normally would, because of my bias, is that I went to a conference in December, a municipal conference, and I was surprised about half the people I talked to there were worried about this. They were worried that there's a good chance that munis could lose their tax exempt status. And these are the people who, we've been drinking the same Kool-Aid for 15 years. And if they're worried about it, then we need to step back and reassess what they're worried about and how it could impact our market. Why am I not worried about it? I got 4 bullet points here that I think summarizes it pretty good. There was a study issued about a month ago saying that each family saves $6,555 a year thanks to tax exempt financing. How does that number come up? Well, you have lower electric utility bills, you have lower water bills, you have lower property tax bills because your county is issuing tax exempt debt, you have lower toll road bills, because all that savings for tax exempt versus taxable piles up to $655 a year. They estimate that if the municipalities had to issue taxable, on average, it'd be 200 basis points or 2% higher financing charges. And then they take that money, they lay it out over all of the issuance, and then they divide it by family to get 655. Now, I'm going to be honest with you, it's a fairly liberal calculation. I mean, I'm going to do some work on it. I don't be next month or the following month. I'm going to go through and just break that out a little bit, because, like I said, They're rounding up, let's just say that, okay, they're rounding up. The second thing though is the biggest cost would come to the small rural communities. The people issuing the 15 million, the 20 million, the 30 million, if they don't have a tax exempt market to issue in, they've got to go to the bank and borrow. They've got to find a way to get money into those little teeny communities. Those little communities were the ones voting for the red party. So are they going to go out and cause their constituents to pay $6,000 more a year in services? The third component is munis represent less federal government regulation. Once again, the Republicans, that is one of their policy stances, right? The federal government in the munis, the state decides what they want to finance, how they want to finance it. The counties decide. They all have their own little thing that they feel is important and they go do it, right? There's nobody telling them how to do it and where to do it. If tax exempt debt was taken away, who's going to manage that whole infrastructure program? Who's going to go in there and regulate that program? And then last, the cost savings for the federal government, if they got rid of tax exempt, would be $750 per family per year. So the loss for tax exempt, 6,500, the benefit to the government, 750. Now, 6,500, like I said, is a little liberal, but there's your ceiling, there's your floor. And somewhere in between is the right number, but the difference is mammoth. And that's $750 per year per family. That breaks out to maybe 10% or less of the gap between what the Republicans, the tax extension costs them versus what this would add back into it. So it's just a bump in the road to do something for you. It doesn't help them a lot, but it sure does hurt the average American. Other outlook items for 2025. These things are, I think, these are the ones I highlighted. We had some others that were in our outlook and other things we've discussed, but stuff continues to evolve in the market. Electronic trading and algorithm tradings. What this is, I mean, you can just go on platforms, you can buy bonds, and you have a market out there, an algorithm market, buying and selling you bonds off of their computerized programming, and it makes for a very simple, smooth execution. I mean, you just go out there, you buy the bond, you can get a bid, but it all comes at a cost. Nobody's out there making these markets for free. When we put out a bid list, we'll put out a bid list, and we'll give people an hour to bid on the bond. And then we have a 15 or 30-minute firm time. So it gives people an hour to do the credit work, to look and see taller clients, find out who has interest in it, whatever. The minute we put those out there, we will get like a dozen bids immediately out of the gate. It's the algorithm traders. And there's market risk, right? The treasuries could sell off. There could be something that happens with the stock. There's something that could happen in that next hour. But they're willing to put their bid out there at that moment's notice. Why are they willing to do that? Because they built in such a profit that if they buy the bond, they know they can sell it and book it for a makeup. So they're there to provide some liquidity, but it comes at a cost. We continue here to work as, in a source of buying bonds broker to broker. We do see the algos out there. I'm sure there's times here or there we've traded with them. It's hard to miss them. They're popping up everywhere, but that is what is leading to the growth in SMA. So SMAs used to be for just 3 million or higher type of clients, right? When we started MainLine West back in 2008, we had SMAs, 3 million or greater, 3 million or greater, 3 million or greater. Now, because of the easy electronic trading and the markets there from the algos, you can get an SMA for 250,000. So you get 250,000, somebody come in and they'll run you a separately managed account. They'll be buying their bonds electronically, buying them easy off the algos, clocking them into your account for you, giving you 50 out of the 2 million they brought, and the other 40 clients get the same bond, and they'll just chug along and do your business. SMAs are taking money away from the mutual funds. The mutual funds were not tax efficient for individuals. So there's a reason the SMAs are able to do their pitch. There's also a reason they're growing, and it has to do with how the muni market and the structure is evolving. We continue here to source about 80% of our bonds from the initial underwriting. But does that mean that means when the issuers come in the market and the major firm Barclays, RBC is underwriting the deal and taking in the orders. All the BlackRocks, all the Nuveen's, all the big boys are putting in for their bonds. MainLine's putting in for their bonds. That is the first selling of the bond. Once those bonds get sold there, other people will turn around and sell them down the line, keep going around. Then they'll get to the electronic platform. And once they get there, you've had people taking their little, 10, 15, 20 basis points the whole way along. So that bond gets more expensive along the way. So we continue to source our bonds, most of our bonds at that initial underwriting. The last piece, as a lot of you know, we've always been working here on climate change. It's been our thing for the last number of years. This last summer, I had an intern in, he did some work on it amongst other things for me. We went through and analyzed fire risk and then with utilities, electric utilities, and then also climate change risk with electric utilities. Went through and found out places that were more geographic locations that were more prone to having fires. We went through and found, utilities that were more prone to causing fires. We found places where floods were more prevalent, places where electric utilities, carbon or coal was their main source. We found other ones who had a lot of alternative sources of power. And went through and defined the ones that we liked, the ones that we didn't like, the ones that could 30 years from now still be good credit quality and issuing debt. The ones 30 years from now we weren't sure could make it. And in that process, we ended up selling some clients' bonds. And in that process, we put some on a watch careful list. And another one, we said, we like what these guys are doing. We will check in with them, but they're making the right changes. So we went through and did a lot of that in July of 2024, and we will continue to monitor things like that. The one thing that we have seen that we do like is that there is more disclosure going on within the deal. So when you open up an OS these days and you're looking at deals, there's stuff in there assessing climate change risk. There's ways how they're going to deal with it. There's cost. And that is all evolving out because of how the industry is starting to demand more of that. And folks are starting to talk more about how that could impact the project in years to come. So what to expect in 2025? First of all, I think there's going to be bumps in the road with stuff out of DC. The first part of the year, it seems as though they're going to be trying to take care of some of their promises, the things they want to change or tariffs, all the headline stuff. But then they're going to have to start looking at the reconciliation, how they're going to make the tax reform stick. And then they're going to start talking about what things they need to cut. And that's when we could have munis come up in the headlights. At this point in time, munis are just, their relative value is as it was last year, as it has been longer term. So there's really nothing priced in there for that. I had thought munis would start out the year a little stronger than they have, but issuance has been higher than normal at the beginning of the year. So we continue to have that dynamic in there as we go into 2025. When there does become a headline news or it becomes a risk and the muni market starts to feel some of the concerns coming out of DC, if those concerns come to light where they are going to start discussing taking away some the higher ed's ability to issue tax exempt hospitals, and those guys start issuing debt and it causes our yields to rise and spreads to widen out, we feel like that's going to be the good time to get back into the market. We're going to talk to you about Fund 8 as we finish up this presentation, but that's what Fund 8 is going to be looking for, a moment like that or moments like that throughout this year as munis come in and out of the headlights, as DC goes in and out of their policies and things they want to take care of. We feel like at the end of the day, because a lot of the reasons I spoke on earlier, that the muni market will demonstrate its ability to finance infrastructure programs in an efficient kind of way and will be something that will still be here for years to come. I signed up for a service a short while ago, and I get all sorts of papers and documents and white paper research for other countries who are looking at ways to mimic the municipal market in their country, because they have infrastructure demands that they need to do. And the little town of Whitchurch in the UK, they can't go to the to the government and say, hey, we need to build a new water plant, can we have money? They have to, they want to be able to control their own financing and infrastructure. The problem they're having though is to find sources of local revenue to back those projects. But the municipal bond market in the USA is highly sought after and prized by a lot of the other countries around the world.
Excellent. Thank you, Mike. All right, so a lot of data here on this page, but really what I would encourage you to do is really just gravitate to really the bottom right-hand corner, and it's really the tax equivalent net IRR. So what you're seeing here is the 4 funds that are in operation. And what I mentioned earlier was 2022, 2023, kind of a multi-generational historic rise in rates. But what I think is interesting here is really it's the bottom line, the tax equivalent net IRR. So really what we demonstrate there is not so much the total return, but protecting our coupon. So Mike is going to go into more detail onto how we think the various funds are going to perform, what kind of the scenarios are that I think ultimately see those funds trading at premiums to their par value. But I think really one of the most telling points here is that we've been able to protect our coupon in the rising rate environment with the short rates changing. So more than happy to elucidate that or expand on that. But I think Mike's going to hit some detail here coming up on these next 4 or 5 slides.
Thanks, Brad. Fund five is now in its 7th year. We tell people the life of a fund is 5 to 7 years. This fund is starting to unwind. We've executed some trades in the last couple of weeks. We had some short call bonds. We had some other assets that were in a good spot to liquidate. Probably about 28%, give or take, of capitals will be coming back in the next number of weeks. We are going to continue to chip away at that. We're going to continue to manage that process when the opportunities come up for us. If munis can catch a strong bid here in the next couple months, that process will be faster. If munis continue to flounder around a little bit, the summer is usually a good month technically for munis. Maybe it'll be the summer. Anticipate that the fund will be fully liquidated and done for before the end of the year, but probably more likely before the end of summer. But we've started this process and we'll continue to manage it and keep you abreast on what's going on and see what we can pull out of it. Right now, as you can see here, the total return is about 6%. There's no reason to think that with a little bit of cooperation, we can get that up to 7, and with a whole lot of cooperation, we can get that up to 8 or 9 for a total return. So we'll be managing that, and Fund 5 has gone through some rough years along the way, but it's on its way to wind down. Fund 6, 6.5 are going to sound like the same fund because they're close to being the same fund because of the timing and how they were invested in on it. Just like Fund 5, I didn't highlight, but this one, the income has gone up, has increased favorably over the course of the last year. Some of that has to do with where we're funding at our floating rate with the money markets and where our swap rate. It's amazing how this trade works with all the pieces moving. And over the years, which piece is the driving force to return? The driving force to return these days on this is the floating rates, not the fixed rates. The floating rates are so offset with what we're receiving on the taxable side versus our tax exempt side that is adding value to this trade. And so that will once again, I think, continue to operate the way that it is because of the demand on the short end and the cash on the muni side. The fund still is sitting below par. It's at 93 cents as of year end. And right now, when I ran the numbers the other day, a lot of these NAVs are still around at the same place. 2005 has just been as it is kind of year so far. We're waiting for the 4% coupons to outperform in there. So we need muni rates to drop a little. We need munis to outperform. to get those 4% back in favor. So we're gonna be focusing the next year, 2 years, whatever it takes for those 4% to get back in fashion and to get back to where they were by just maximizing our payout. All right, we're gonna be looking to manage your payout. This one's 563 on taxes, and we're gonna be focusing on trying to get that up and allow those 4% coupons to heal and bring themselves back up to par, and then at some point, hopefully a premium. We did some stuff at year end. We did it with fund 6.5 and 7, where we put some cash back to work on some short calls we had, kind of what we did with fund 5, and got some of our kind of re-leveraged the fund a little bit. 6.5 is about the same kind of story. It's just a little shorter life, a little bit lower payout, but we've done some things actually the last 2 weeks that have bumped this back up a little higher. But it's the same kind of process as fund 6. Wait for the 4% coupons to heal and outperform, and in the meantime, try to maximize our payout and our leverage in those funds until that point comes around. Fund 7's well on its way to, meeting its fund objectives, what we planned for it. It's kicking out, once again, its income has gone up over the year. The NAV for it is slowly appreciating as the arbitrage trade matures. We put on a few trades for it at year end and at the beginning of this year to re-lever some stuff and trade out some shorter call bonds to put stuff back out on the curve. We'll continue to look for opportunities to add value to this fund, but the fund at this moment in time is doing what we anticipate to do, and doing what we've told the investors it will do, and we'll just keep you up on that, and just keep looking, like I said, for opportunities where we can maybe add a little value to the NAV at the end of the term.
Excellent. So Mike, I'll take over here. Really want to talk about, our continued effort to just be as transparent and provide as much information as possible. So you're going to see more information and more updates on a regular basis from us. You're going to see monthly updates on the fund performance, exactly what we're doing within the fund to maximize investment objectives and total return, as well as the coupon. The second bullet point here is that, really, what we want to do is, crank out that high tax exempt payout that gets distributed semi-annually. As Mike has highlighted, we think that the red wave risks are interesting and are very likely to provide a good opportunity to execute Fund 8. So in light of that, we're capital raising, as we speak, getting our final documentation, and we'll distribute that. Largely staying with the same idea in terms of cranking out that high tax exempt coupon, as well as having the total return opportunity. We're very far along with our bank partners. We anticipate Barclays and Wells Fargo, as well as Bank of America, going to be our lead finance partners. And most importantly, our team is stable, and we're in this for the long term. So really looking forward to the capital raise of Fund 8. So just stay tuned on that. Really would open up to any questions. If anybody's got anything that they'd like to cover, we're game.
You can type in the chat. Do we need to mute people, or just gonna mute themselves?
Yeah, I think if you guys just want to unmute yourselves.
If you have questions, or you can chat, you can type in the chat too, if you come back on that. Are we being shy, or is everybody having any questions? This was recorded. You can share it with people, share it with your clients. You can call us up, email me, talk about it. You have other thoughts or ideas or questions that come up.
See if we can unmute people if they want to be. I think everybody's in good shape. All right, well, it looks like if everybody's all set, you know, again, we're totally available. If you've got any questions or concerns, we're all available at the drop of a hat. So looking forward to staying in touch on this.
Thank you.